Welcome, everyone. Hi, Daniela. Nice to see you. Where are you logging in from? And as people are jumping in, I think I'm going to give people about 3 to 4 minutes to just get situated and we'll get going. Hi, welcome. Welcome, Usiakimi. Nice to see you. Hey, Ramon. Oh, Texas people in the house representing. I hope everyone is getting ready for the holidays. It's a little chilly over here. I could use some Texas heat right about now. Hi, everyone. As you're coming in, I just want to give everyone a few minutes to get situated, to get settled, and then we will get going. Welcome, everyone. If you're just logging in, we're going to give everyone a few minutes. I'm thinking 2 more minutes and we'll get the show on the road, which I'm pretty excited. Hi, Mona Lee. Oh, nice to see you. And everyone, please ask questions. I'm going to repeat that over and over and over again. As many questions as you can get, as I can get. I'd love to answer it. I'd love to give value, just to kind of all increase our knowledge and our awareness. Hi, Tiara. Glad you're here. Aw, thank you. Okay, we said in a few minutes we'll get started. If you're just joining in, you could, the chat is open. The questions are also open. Use whichever one you want to toss in questions, comments, say hello, say hi, say where you're coming from, and we will be starting in 1 minute. Hi, Danielle. Nice to see you. Tuning in from Maryland. Yeah, oh, another cold state. Okay, so all the Texas people and the Florida people where it's warm, wear a little jelly. You know, when you're watching the time, it seems to crawl. Okay, it's 6:05. Let's get the show on the road. For those of you who are just joining, welcome. I'm happy to have you here. We are going to get started. So, like I said, welcome again. Before I start, I just want to take a second and I want to ask you a question. I want you to think about what I'm about to share with you. What I'm about to share with you will really challenge everything that you think or you know about building lasting wealth. And by the end of this presentation, you will better understand why the ultra wealthy seem to effortlessly preserve their wealth while others are struggling. First of all, I want to say thank you to everyone who's joining me on this Thursday evening. I'm just happy and I'm grateful for all the support. And I hope that this is bringing you a ton of value because at the end of the day, we want to figure out really how to preserve wealth. While others are struggling, we're not going to be that person. So my name is Dr. Nkem Ezamama. I'm an ER physician and I'm based out of Nashville, Tennessee. I am the CEO and founder of Phoenix Capital Investment. And really our goal is to just help busy professionals build wealth through passive income in real estate. So welcome. I'm excited to have you here. I said this before, I'll say it again. Use the chat, ask questions. If you want to ask questions in the questions section, you can use the chat, just engage. I will keep an eye on it. And so I'll refer to it if you guys have any questions, immediate questions that I can answer. So This is a shocking statistic, which is that 70% of wealth is lost by the second generation. And it represents millions of families who thought that they were doing the right thing. And like I've seen traditional investment advice fail to address this reality, which is that it doesn't last past the second generation. I do want you to recognize that there is a better way, and that's what we're going to talk about today. So while most investors are chasing returns, right, the ultra wealthy investors, they're focusing on something that's entirely different. And there's a reason why certain families maintain wealth for generation after generation. And the question is, how are they doing it? In the next few minutes, more like in the next 60 minutes, we'll be able to discover some of those secrets. And what I'm excited about is that I want to share with you to really explain to you why many ultra wealthy investors are making certain moves right now. So in the market right now, we're seeing kind of three critical market conditions that are converging for the first time since like around 2010. Interest rates are at a pivotal point right now. There is a market hungover from a ton of speculation, like, is this the right time? Is this the wrong time? And then we're seeing a lot of demographic shifts that are creating unprecedented demand. And I'll specifically talk about that. But what you're seeing is that most investors are still focused on the headlines, which is what's happening with interest rates, banking issues, market volatility. But if you notice, the ultra wealthy, the super wealthy, they're doing something different. They're seeing opportunity in the chaos. And that's very important for you to realize and for you to understand. And that while there's frenzy, people are still investing, people are still buying because assets are still available. That is exactly what I'm going to focus on. And I'll show you exactly what they're seeing and why this particular moment is so crucial in wealth preservation. Let me just tell you right now, I will throw out a lot of numbers. There will be a lot of math, but it's important because we are talking in millions. So I want you to think about a pressure cooker, right? It's building so much steam. And each of these forces, they create opportunity. But when they converge together, then they really start building generational wealth. That's when we start creating generational wealth. So for interest rates, right, we're seeing something fascinating in the rate environment. While there's panic about the high interest rates, it's slowly coming down, but the ultra wealthy, they're seeing periods to lock in exceptional deals. You have to know this because they know this, that the rates are cyclical. So like they will come down, they'll come back up, but they'll come down again. But these good assets are forever. So like when you find the right asset to dig in, you should. And you also notice that with the market correction, right? The correction that we're experiencing, it's almost following a predictable pattern. In every cycle, there's that sweet spot where, you find some institutional quality grade assets that become available at a significant discount. That's a window that we're in right now. And so you should be very aware of that. But here's what makes the cycle a little different, right? We're experiencing this weird demographic shift in US history. And we're seeing like 72 million millennials are entering this prime renting years. So, and then also think about baby boomers who are downsizing at the same time. And this isn't all speculation. So it's math. When you look at these three factors, notice how like one is affecting the other, right? That's exactly how like wealth is created massively. It's in these previous cycles, but it's only for those who recognize that and then act on it. So now I want you to think about where we are today, right? Fast forward to 12 to 24 months when the markets have all shifted and all these opportunities have passed. Those who acted 12 or 24 months ago, those who secured those positions, they will start generating wealth, and they're not just doing it for them, they're doing it for generations to come. So it's like the right time is what's the most important. And I'll say it again, like there is opportunity in chaos. You just have to be really aware of that. Also, it's the end of the year. So as you're listening and as you're thinking, what are you doing to get yourself ready for these market forces that are about to converge and they're already convergent? What assets are you investing in? What are you thinking about joining? So I want you to look at the last three market cycles, right? Think 2001, 2008, 2020. In each case, we saw a clear pattern, right? You saw stocks that were dropping at an average of like 35 to 37% during those corrections. But if you notice something, institutional real estate, so apartments, they remained remarkably stable. If you look at the 2008 financial crisis, right, the S&P 500 dropped over 50%, around 52%. But if you looked at what happened to like well-positioned real estate properties during that same period, they did not only like just preserve their capital, but they actually increased in value. And so like and if you also think about something, right, the ultra wealthy, they hate volatility. So while we are typically allocating like 30 to 40%, I'm changing, to portfolio classes such as stocks and bonds, they are doing a lot more than that in hard assets and real estate. But one thing they're also not trying to do is that they're not trying to time the market. They're trying to transcend the market. So that's really important for you to remember. It's like, we are not trying to time the market. We're just getting educated so that we know the right time to invest in, and then just wait. One of my long-term investors said this, and he said something that was really profound. He said during one of the prior market crashes, right? He said, I never worried about my real estate investments. I was just too busy collecting rent checks and distributions. That's what we want. That's what, like, let's position ourselves so that we can say that in the future. So I want you to pay close attention. The next two slides are pretty important. And these are the three key foundational principles that every ultra wealthy portfolio needs to have, and you need to remember this. So you have to think preservation first. And here's what that means in real numbers, right? If you think about a traditional approach where you're just like your maximum return, the results are like you are investing because you're thinking short term, you're investing in maybe things that are a little bit more highly volatile. So think 25 to 30%. But if you take those same certain risks, right, you can have up to 40% drop in bear markets. But the ultra wealthy, their approach is a little different, right? They are saying that the losses that they're willing to really accept is more like a 15% loss, but they require that their income coverage is like 2 times their expenses. But their minimum liquidity, they have to make sure it's about 24 months. And then when you risk adjust for what I just told you, you're looking at still making anywhere from like 12 to 15%. So if you look at like a $10 million portfolio on preservation, right? 4 million of that is in income producing hard assets. That's like about like 8% in cash flow. And 3 million of that is really in like private credit. So you're still getting like 10% yield. And about 2 million is in like strategic positions. So think about that. Like, you always have cash flow. That is something that is really important when you think about preservation. You're thinking about, how can I preserve the wealth that I have for a long period of time? And then the next thing you have to think about, and this is very important, is that think in decades. This isn't about, patience. It's really about math. So the returns you'll get in like a 1 to 3 year frame is not as, you won't get as much if you're thinking like, you'll get way more, sorry, if you're thinking 10 years, if you're thinking 20 years. That's how the ultra wealthy start thinking about. So they're thinking about, like, in addition to preservation of capital, it's thinking in decades. So I'll give you a real life example, right? In 2014, in the Phoenix, Arizona, the apartment complexes there, their purchase price was about like 120,000 per door per unit. Now, these ultra wealthy, some of these ultra wealthy investors, they held those portfolios for like 12 years. And the current value right now is like 375,000 per one unit. That is around like 400% return on investment. And why is because, like, when they think about like the right places to buy, and that's something we'll talk about, right? They're buying based on demographic trends. So they're focusing on population growth. They're focusing on like market targets, which have like significant job diversity. They're also looking for like infrastructure. So when they're thinking, even though they're thinking long term, there's still fundamentals in their thinking. And I'm going to give you just a way to really think through when you're thinking about assets to buy. But that's how that you think about. So think about wealth. You're thinking about preservation first, and then you're thinking about like thinking in decades. And then the next one you're thinking about is like tax advantage growth. how can you start compounding the effect of those tax advantages? So you're thinking, the ultra wealthy are thinking, um, in depreciation. So in like if with an 8% return, right? If you invested, let's say just we use 10 million because it's easy math. 8% return is about 2.1 million, right? But then if you think about it, they're thinking about tax advantages. So they're thinking about depreciation benefits. They're also thinking about cost segregation benefits as well. They're thinking how can they move money that they're not really using right now from one property to another one through 1031 exchange. But this is how they're thinking about also using their tax advantage growth in order to grow their wealth. And so we're going to talk about Growth Parkview, which is our current investment opportunity. And that embodies all these three pillars that I just told you about. So we have like preservation of capital. We just found out that property is actually worth $60 million and we're buying it for 49.1 million. So right there, we're already having like preservation in our hard asset. And then think in decades. So think about like in that property, there's been 40 years of economic life in it and it's continuing to grow. And when you think about like tax advantage, we are doing full cost segregation on the property. And all of those is just how we're thinking, like the ultra wealthy is thinking. And they're not thinking quick. I'll say this again. They're not thinking quick. They are thinking get rich slowly and then stay rich forever. And I see questions in the chat. I'm going to answer all of those. But so when you think about this, I'm going to spend a little bit of time on this slide. I told you it was these two slides that I'm going to spend some time on, but this is the kind of insight that is usually reserved for the ultra wealthy, right? And the first one I said is like really focus on preservation. And that's thinking like, how can we preserve this while it's growing? So when you think about normal investors, right, they're thinking a 50% loss will require 100% gain just to break even. But when the ultra wealthy are thinking preservation, they're thinking, I'm not going to try to lose 50%. I am okay with like 15% loss, worst case scenario. And when you average that over a long time, while others are losing like 45%, they're only losing like 19%. I said it before, I'll say it again, think in decades, not quarters. So, and that's how that will play out in practice, right? Because you'll see that like ultra wealthy investors are holding, property. They're not doing 1 year, 2 year, they're thinking 5, 10, 15, because it's in that lengthy period of time that you can really focus on demographic trends. And then you don't have to deal with all the market cycles that come like every few years. And then they will accept like a 68% annual return. If that means that if you hold the property or whatever it is for over 10 years, you're getting like a 15% average annual return. I'll say it again, think long term. And then we talked about seeking tax advantages. It's very important because like every 1% that you save in taxes, it's actually almost like an extra 20% in wealth over 20 years. And those are like some of the specific strategies that we talked about, which is, cost segregation to accelerate depreciation. So how much can you get back in year one in taxes? Think about 1031 exchanges. So instead of paying capital gains now, you can take the profit that you got from a property and move it into another one. That's something to think about. Then another thing that's very, very important is to prioritize hard assets. And that matters because like hard assets, they will typically, they'll appreciate 2% over inflation every time. And so that's something to think about when you're like, where do I really want to invest my money? And you can see like there are different types of hard assets that you can benefit from. And then when you think about hard assets, the reason why they're so good is because you benefit from appreciation. You also benefit from cash flow. You benefit from the tax benefits and then the debt pay down. All of those things are really important when you think about prioritizing hard assets. And then the last one, which is you have to make sure that you're getting cash flow. So this is a non-negotiable. In everything that you're investing in, you need to make sure that you're getting cash flow. And the ultra wealthy, they're okay with like a minimum of 6%, 7% cash yield because it's over time. But then with cash flow, you also need to be getting monthly distributions or quarterly distributions. Those are all the things that will keep adding. So when you're thinking about these principles, you're thinking compounding, one thing stacking on top of the other, stacking on top of the other. So I want you to, as I'm telling you all these principles, right, what I want you to do is to be thinking, how can I implement this in my own portfolio? And if you're just starting out, that is still okay. The best time to have started was 10 years ago, but the next best time to start is today. That's what you have to start thinking about. And also, I want to say, like, all of these principles, they really build on each other. And I think that's the most important thing. So we just talked about the principles, right? Now I want us to shift to the silent killers that most investors never see coming, that is actually hurting them. And while other people make this mistake, you're here today, so you'll know better. And once you understand these things, you will think about investing a different way. So I gave you principles, and then I want to make sure that that these things are not hurting you. And number one is relying on the stock market. The second one is ignoring inflation. You have to pay attention to it. The third one, which we have talked about, touched on a little bit, is missing all the tax advantages that are available to you. And the fourth one is like neglecting alternative assets. So where else can you put your money? So I, in the last 20 years, I want to share with you kind of what has happened in the stock market, right? You will see something, you'll hear something that's a little shocking, because the average investor earned just around 2.9% annually, while the stock market actually returned about 8.7%. But what's really interesting is that, like, when you look at the numbers, right, the S&P 500 actually had negative returns 7 out of those 20 years. And the average recovery time for every time there was a dip, every time there was a drop, was about 3.1%. And even in like tech savvy portfolios, they saw a drop in about like twice, they saw like a 70% drop in that 20-year period. So that's why, like, it takes longer for you to recover during those recovery periods, and it's a lot. So it's not just about the drop, but it's about the opportunity cost that happens during those recovery periods. So when you think about it, like, diversification is also just as important, and that's another thing that, like, the ultra wealthy really understand. In 2008, what we saw was that the stocks, they fell about 37%, and bonds fell. The bonds also fell, but they fell closer to 20%. And in 2022, stocks and bonds also dropped simultaneously. But the ultra wealthy, they kind of approach things a little differently. So, like, instead of only dividing their money into stocks and bonds, they divided it into other additional profit centers. So they're also investing in stocks and bonds, but the percentages are different. And so what they did instead was they did about like 35% in public markets, but then they did almost close to 42% in like income producing hard assets. So think apartments, think storages, think just different other like hard assets, as opposed to just stocks and bonds. And then they also did a little bit of like private market opportunities, and just very little in like cash positions. And because they did this, while others lost about 45%, they lost about 19%. And that is okay. But like in 2022, some of them gained and didn't lose anything at all, while we still struggled with like a 28% loss in our traditional portfolio. So, and that's what you have to think. So when you're looking at opportunities, you have to make sure that you're looking at opportunities that don't correlate with the stock market. You're also looking at opportunities that are giving you monthly, quarterly cash flow. You're getting distributions, and then you have hard assets that are backing, your investments, that are not, they don't fluctuate with every single market sentiment. That's how you protect yourself. So what if I told you that a 7% return could actually be losing money? You're like, oh, I'm making money, it's a 7% return. But I want to show you something that changed how I really looked at wealth preservation. And that is something called, well, when we think about the silent wealth killer, right? What's really happening to your money? When you think about, like, when we talk about inflation, so $1 million in 2000 needs to be about like 1.78 million today. So around like 1.7 million to buy the same goods that you would have bought for 1 million in year 2000. And then also in the last 3 years, right, real estate taxes went up, but also not only that, insurance premiums also went up, and insurance premiums went up by like 30%, but medical costs also went up. So like that, your 1 million, or now even that your 1 million and your 1.7 today, for the same goods, it's costing significantly more. And the ultra wealthy, but their focus is a little different. And that's what I also want to talk to you about. It's like the purchasing power. You think about like regular real returns, and Mona Lisa said everything went up. That is completely true. But those things specifically went up significantly, that we actually noticed a significant difference. But when you're thinking about real returns versus like nominal returns, right? I want to show you what that looks like I want to show you a good example of what that could look like. So think about an 8% return. On paper, when you take off inflation for your 8%, that remember when I told you 7-8%, you could actually be losing money? I want to show you how. So like your 8% return, when you take away 3% for inflation, and then you also take away 3%, which is like from taxes, really all you have is like 2 to 3% left. But when you start thinking like the ultra wealthy, right, that their 7%, it's in something different. It's in maybe a hard asset like real estate. So with that 7%, you're also going to get appreciation. Plus, you're also going to get maybe like a 2% debt buy down. You're also going to get tax benefits, right? Because now you're getting depreciation. So that 7% actually looks like 14%. It's because you're putting it in the right type of class in order to make that money. So you're not just focusing on just the return. You're not thinking, okay, I'm just getting my 8% return, but you're also thinking about appreciation. So it's return plus appreciation. And that's how you're able to protect yourself. So you go from nominal return to really getting real returns. And then another thing to think about is why traditional inflation hedge fails. And that's because like there's a lot of flaws in the things that we think about, like common inflation hedges. So like you might think, okay, I'm going to put my money in gold, right? But there's no cash flow in gold. You have to store gold, and so then you have to pay for storage costs, and then it's really volatile. So the things that you think you're going to hide your money, you're going to hide, so to avoid inflation, you end up paying more. And then REITs is another way. So real estate investment trust, right? But it's also a public market. It correlates with the public market. So whatever happens to the stock market kind of happens to it, and there are no tax benefits with that. So you are thinking, okay, these are ways that you're in your mind, you're like, I can make like hedge against things about inflation, but then in the things that you're doing, they're really not helping you, and they're more hurting you. But instead, focus on assets that have organic rent growth. So things that are bringing in steady income on a yearly basis. And then think about markets that are, that have really strong wage growth potential. And then structure your deals like Grove Parkview, where you have fixed interest rate. So, and you have long-term debt. So you're not worried about floating rate. You're not worried about whatever happens with the interest rate market, because you know that you have fixed rate, and you have long-term debt. And then make sure that like whatever you're doing in your investment, that you're getting some sort of like annual rent increase. And so you're targeting markets that the rent is also growing. So this is something that like a lot of investors, they make a mistake on, which is they focus on just returns. And they only focus on returns before taxes. That is a really big mistake, because a lot of investors, they think that they want to keep more than twice of their returns, but that's really not what happens, because then after taxes, you end up losing a significant amount. So once again, I told you we're going to look at real numbers, because I think with real numbers, you can understand. So in a traditional approach, right, you have a $1 million investment. And in that, let's say you got 10%. So you got a $100,000 gain. You're going to pay taxes on that. So let's say you're in a high income earner. So you're going to pay 37% federal tax. And then you're going to pay 13% on state taxes on that. So that your return, that your $100,000 return now looks a little like $50,000. But when you're thinking like an ultra wealthy investor, that same 1 million where you got that 10% return, which was 100,000. Think about a 30% tax shelter through depreciation. And that's very important. So with deals that you're getting into, with real estate investment deals, make sure that the operators are doing cost segregation so that you can reap those tax benefits. And then also, a lot of ultra high net worth investors, they also have businesses. And so they get 20% qualified business income deduction on that, their 100,000. And then, like I said, they get tax-free cash through cost segregation. So that $100,000, with the traditional approach, you are going to get back around 50,000. And now with this, when you have that ultra wealthy strategy in mind, like how am I going to do this? How could I get to keep more? Your returns are looking like 85,000. Just pay attention to that. That is a 70% difference in what you actually get to keep. So 50,000 versus your 85,000 on your 100,000. And that's what you have to understand. So start asking the questions, start figuring out the strategies, start talking with your financial advisor, your CPA. But these are questions that you need to ask because you need to have the right people who are advising you so that you can make these good decisions. And when you think about like why the traditional tax advisors, like why sometimes they fall short, is because they focus on deductions instead of really like tax structuring, and they're ignoring a ton of like timing strategies, and then you miss stuff like depreciation, which is very, very important. So that's actually how you have to start thinking. These are the questions that you need to start asking. And then another, just like an aside for the ultra wealthy, when they start thinking about tax strategy, right? They start thinking, the first thing you think about is structure. So then they create trust. And then they start doing strategic entity planning. And then they have holding companies as well. Another thing they do is like timing. Remember, I talked about timing. So it's like you think about like strategic loss harvesting, think about 1031 exchange. How can you move money without having to pay additional taxes? And then you think about bonus depreciation, cost segregation. All of this is how the actual playbook is starting to get formed. And that's how you start saving money. So it's what really matters is not what you keep, but it's like where the wealth is going and how you start to build it. That's what you have to start remembering, and that's what you have to start keeping in mind. And so when you start neglecting alternative assets, right? What if I told you that the ultra wealthy only keep 25% of their wealth in traditional investments? And that's like because they are putting an additional about 75% in different alternative assets, different assets that are working, that are not correlating with the stock market, so that it can be growing. So when you think about a typical family office who invests heavily in, let's say, real estate, right? The breakdown is different for how they invest. It's usually 25% like traditional. And when I say traditional, I mean like stocks and bonds. And then they do about 35% in like income producing real estate. They might have like 15% in private equity and then 15% in like direct business ownership. That's how you have to start strategically thinking. And a lot of us, you might be thinking like, I'm not there yet, but you have to know these strategies right now so that when the time comes that you'll be making the right decisions, from the start. And with that mix I just told you, it has significantly outperformed traditional portfolios by like 64%. It's provided 3 times more tax advantages, and you're getting about 2.5 times the amount of money in cash flow, and it's not as volatile. That's how you have to start. So you start looking at like the real breakdown in how the performance is doing. That's when you start really capturing what the traditional portfolio looks like versus what the ultra wealthy portfolio looks like. And then when you start also thinking about, like, you might be asking, what are alternative assets? What can I put my money in? How can I grow investments? So think real estate, obviously. Think multifamily apartments. Think value add offices. Think about industrial development. You might also even think about like operating businesses, thinking about entrepreneurship as a way, or even investing in businesses that are already operating as an alternative asset. But that's how you have to think about it, because when you do that, then your returns, you're getting multiple profit centers. So you're not just relying on one thing. And I keep breaking it down because it's so important. Then you're getting cash flow. Then you'll be getting appreciation. Then you'll be getting tax benefits. You'll also be getting debt pay down as well. And all of that is increasing your return. So then you could now be thinking about, in like your alternative bucket and your assets, you're looking at like a 20% leverage. That's why you have to, and that's how they're thinking. And so this is like a secret wealth killer, because we shift all our money, all our investing to just stocks and bonds, but we really shouldn't be doing that. We should really now still keep some there, because I 100% believe in diversification. But after that, you now need to start thinking about other places to shift it to. Like I said, income producing real estate assets, private equity, direct business ownership, those are ways to start really to start improving your portfolio. Okay, so I talked to you, I kind of hinted it a little bit. Yes, thank you for, yeah, the good examples, but they're things that we need to start doing. And like I said, I know that, some of us are not there right now, but this is the start. I think the first step, and I don't think I know, the first step is getting educated. And then, so then you have the right tools in your tool belt to go out and make the right decisions. So I've told you what the ultra wealthy are doing instead, right? I want to talk to you about like the strategies to really build wealth and to build it for generations. I want you to pay attention to how those three pillars align with what you're doing, what you're thinking. Of all the alternative investments, right? Real estate stands out. It aligns perfectly with how ultra wealthy investors, how they think, and there's a level of stability that comes with it when you add it to your portfolio. So I wanted to spend a little bit of time to talk about our newest investment opportunity, which is Grove Parkview. And I want you to, with all the things that I've told you, I want you to see how it embodies some of the some of the aspects of why this asset class is so powerful. So as you listen, and this is where I want you guys to like ask questions, because I think it's important for you to help. It's important for me to help you understand why and where you need to start investing in. So we are really, really excited about Grove Parkview, and for reasons why, and I'll share that with you today. Number one, it is a beautiful apartment complex. It's 268 units, and the number that speaks volumes is that it is 96% occupied. And these are all great stats, but I think that they're indicators of something bigger and something better. And when this opportunity crossed our desk, I was very, very excited. Before this opportunity came, we had sifted through tons of opportunities, and we kept saying no. And when we found this, we just knew that, like, while others are seeing this as just an apartment complex, this is a property that is positioned to become something even great, something amazing. And I want to tell you why. So what first caught our attention is that it's in Stone Mountain in Gwinnett County. And Gwinnett County is not just another Atlanta submarket, right? It is poised to be one of the largest counties in Atlanta in the next, I think, like 5 to 7 years. And this location checks all the boxes from a very strategic standpoint. So the things that get us really excited, that get me really excited, is that the kids who live at Grove Parkview apartment complex, they attend Parkview High School. And that is one of the top performing high schools in all of Georgia. And it's rated about an 8 out of 10. But not only that, major employers are just 15 minutes away. And that just shows how stable, that community, that submarket is. Tons of employed tenants, healthcare, tech, manufacturing. And if you were paying attention to the news about, I think 2 weeks ago, Rivian EV, I think they're in the process of getting about $5.5 billion to start building. And that tech plant is going to be in Georgia, right outside of where this apartment complex is positioned. So all of those it got our attention. But even more important than that is that there's limited new construction that's coming to the area. So all of those is poised to just make this a great asset and a great location. So you combine great schools, you combine easy access to jobs, and then restricted supply. It just creates something powerful, which is demand. So some things that you kind of should know about it, and I hinted about it, is one of the things is the school. But when you think about a school, right, something special happens with great schools. You don't just get tenants, you get families, you get professionals, you get people who want to invest in the community, and just because of how great the school is. And that speaks volumes because our occupancy tells a story. It's been over 95% occupied for about 10 years. There's a data that was done, and it looked at 20,000 zip codes, and they found something remarkable. They found that properties that are near schools, they maintain about a 12% higher occupancy. And then residents with great schools, they stay about 23% longer in great school districts. And that, I think, is a game changer, because that also causes the property value to appreciate faster. And this study showed that it appreciated 35% faster. So when you think about that, like all of that is how we start to connect the dots, right? More stable income, lower turnover, stronger appreciation, and families want to be there. That's one of our main reasons why we love this area and we love this property. Now, I also want to show you something that is really interesting. So we are going in and we are planning to renovate about 105 units. We feel that they are really ripe for transformation. And we're not just guessing the results. Like we're not going, we have really truly have a value add strategy that we're picking those apartments and we're going to renovate them. But like I said, we're not just guessing that we're going to get results, right? The current owner who's selling, they have already used this approach and it's proving to be very successful. So our plan is we're going to go in and we're going to renovate. We'll make it better living conditions for the tenants, but we're also increasing value for our investors. So look, this is what's happening right now. Like currently, that property is getting around 120 to 410 in additional rent per unit that is renovated per month. And that is about like a 65% return on the renovation investment. And these upgrades were like, they're knocking them out in like under 30 days. But what really got our attention is that, like I said before, like they're not just projections, right? They're actual results. So these renovated units are leasing within 7 days. They're not adding any additional incentives. So sometimes if you think about like if you rent or you used to rent, right, you need incentives like 1 month free or 2 month free or, like security deposit waived. We don't need any of that just because it's doing so well. And the best part is like there's a waiting list. So when you look at these numbers, right, we are not just hoping that these numbers work, we see them work. So like we are not just assuming, when we're going to buy this property, we made assumptions, but we're seeing it coming to life right now, real time. So when you put all these pieces together, you have a location that has really attracts like long-term tenants because the school district is so good. And then you have a renovation strategy that is already working. And then you have a high occupancy and a clear path to increasing value, which is our value add plan. So it's not speculation. It's not like we're hoping that this property is going to appreciate. We're seeing that like it is truly an institutional quality asset and it has multiple proven ways that we're going to grow our returns. That's why the fundamentals of this is so strong, and that's why we really like it. So I want to spend a second and pull back the curtain and really show you like how we analyze our opportunities. So we don't just run our own numbers, right? We pressure test them against CoStar. And CoStar is like if you think about the best way to describe them is like they're the industry's most trusted data source. So we go to them for any information, any data source that we need when we're looking at apartment complexes all over the country. So in order to figure out the value of the property, we depend on two factors, which is your net operating income and your cap rate. And the cap rate, the easiest way I can help you understand it, it's a metric that is used to estimate like the potential return on investment of a property. So these numbers are important. They're very important. So CoStar projected that this property, we would get an exit cap rate of 4.6%. So to get the value of the property, right, I told you it's net operating income divided by the cap rate. The cap rate is in the denominator and the cap rate is a percent. So if you remember some math, I told you we're doing some math. The lower the denominator is, the higher the property value is. So CoStar, which is our industry's trusted data source, they're saying that we're going to exit at like 4.6%. But we are a little bit more conservative. And based on our calculations, we think that we're going to exit at around 5.3%. And what does that mean in terms of our investment, right? With our conservative approach, if you invested, you would make about 1.7 times the amount of money that you put in, anywhere from like 1.7 to 1.9, depending on the investment class that you invested in. But CoStar is saying that like when we exit, you're going to make about like 2.1 to 2.3 times your investment. So these numbers are not just numbers on a page. What you have to understand, it's our commitment to really under promise and over deliver in everything that we say. And that's why we go in with conservative numbers that we know that will still get you really amazing results. So let me show you kind of why these projections are not just wishful thinking. Since 2020, and I want to show you how numbers, I'm all about numbers, and I want to show you how these numbers really tell a story. So since 2020, this submarket, Gwinnett County, and where especially where Grove Park View is, it has seen a 23% increase in rent growth. Remember when I told you that ultra investors, one of the things that they focus on is rent growth, and they were just okay with 2%. But since 2020, the submarket has done 23%. Even during a pandemic, even during during like market fluctuations and uncertainty, and during every market cycle, up or down, it has still maintained an occupancy of 95%. It's not luck, it's truly fundamentals. And I think that what seals the deal is there's no competition, right? There's new construction is like actually declining in the area. So it's growing demand, limited supply, all of that is helping us. So in that submarket, right, I told you it's almost like the perfect storm. New apartments, there's no like in the last within a 3 mile radius, there are no new apartments. The existing properties at 95% occupancy, and then population surge. So in the last 4 years, it has grown about 12%. Plus, I told you it's going to be the largest county in the next like 5 to 7 years. So this is like, it's not coincidence, right? It's economics 101. Growing population, limited new supply, and then maximum current occupancy. When all of that converges together, like we're seeing a really amazing, cool catalyst form. And that's what makes us even more confident in the opportunity. It's not just because of like optimistic projections that we're going to do great. And it's not because of market hype, but it's like the fundamentals are undeniable. Like, and I think you see it too. But that's what we focus on. We want to make sure that like when we go in, when we purchase a property, that the fundamentals are really strong, and that the numbers are really telling a really compelling story. So what does I want to make this a little bit more tangible for you, right? What does $100,000 investment look like? That looks like you're making about 15 to 18%, and that looks like 15,000 to 18,000 every year. So whatever you're doing, whether you're working your 9 to 5, if you're seeing patients while you're living your best life, that could look like, you know, getting about $3,800 to $4,500 deposited in your account on a quarterly basis. And that's like, you're not hoping to see stock market gains, right? You're not waiting for the perfect exit. Like, it's just real income that's flowing straight into you. And so we're talking about that. And if you think about 15 to 18%, right? The S&P, and it's doing great, you know, historically is given about 7.8 to like 8.1%. And so they're not empty promises. It's like, it's what we're seeing right now. And then, and I want you to remember those strategies I talked to you about, right? I talked to you about, you know, the annual returns. I talked to you about distributions coming in. And then what's even more powerful, which I talked about, was tax benefits, right? And this is something that like the ultra wealthy investors, they know that it's not just about returns, but it's like really understanding the tax code. So when these ultra wealthy, when they acquire properties, they're not just buying the real estate, right? They're accessing one of the most powerful tax strategies in existence. And one of them is depreciation. So at Grove Park View, we have already done cost segregation on the property. And for a $100,000 investment, you can generate about $27,000 in tax savings. And that is just in your first year. So these are the same tax strategies that I told you about, and it's coming to life here. And these are the same wealth building tools that they're using. We are also using them. But the thing is, like, you don't need, remember when I told you have to start somewhere? You don't need billions to do it. You know, you can start up with 50,000, you can start up with 100,000, and you can start building from there. And that's what those returns look like to you. So in year one, if you're getting, you know, your 15 to 18,000%, $15 to $18,000 in annual returns, plus you're getting $27,000 in depreciation, that looks like a 42% benefit in year one alone. This is how, I hope that it's like the light bulb is going off and you're starting to think this is how it makes sense. And so these are the three classes. We built 3 different classes. So just depending on like what you want, we have a class A, which is more of a security position. So they're getting 10% preferred return. The minimum investment is 100,000, and that's just based on cash flow. So they're not getting any of the upside or the appreciation at the end. I talked about appreciation in the beginning. They're just saying, I want cash flow. I want it today. I want predictable returns, but they're not benefiting in the upside at the end when you sell. Then you have Class B investors. The minimum investment for this is $50,000, and you have about a 6% preferred return And then you have a split, which is 80-20, and that's above your preferred return. And that's where you start getting that 15.5 to 18%. And this is ideal for like people who want steady income, but also want the potential upside benefit at the end. And then Class C is like our power position, right? So it's 750,000 is the minimum investment, and that looks like a 7% preferred return with a 90-10 split. So and this is not just a random structure, right? This is exactly how institutional investors, they design their portfolio and their positions. And so we wanted to bring it to our investors so that you can have the same advantage. Debt. I talked to you about debt a little bit. We have locked in a 5-year fixed debt at 4.74%. And so in today's market, in the last few years, where you've seen significant fluctuation, and even today, where you're paying 6% or more, we've secured around like it's not around 4.74%, and that's fixed for the full 5 years. And so it's not just about, it's not just about saving money. It's also about certainty, and you need to make sure that you have that. So no interest rate surprises. We're not refinancing until 2029. And then you are getting about a 1.25% advantage over where market rates are today. So I wanted to harp a little bit more on school district because I think it's just really important. And it's like, it tells a kind of fascinating story. We did research, Zillow did research, and then I did research through Zillow. But like, parents don't just prefer good schools, they are willing to pay about 20% premium to access them. And then they're willing to stay longer. So that's why this is so important for us. That's why we are really excited that way. Like it's zoned to such a great school district. But it's not just another property, right? It's a combination of like strategic location, protected debt, proven demand, and then institutional quality. That's what makes it really cool. That's what makes it really amazing. I've been saying we, and I just wanted to quickly tell you who our team is. I think this team is fantastic. I know because I've worked with them, and I think they're 10 out of 10. But I want to introduce you to them real quickly. These are our strategic partners. First is Excite Capital. They are Dr. Julius Oni. He's an orthopedic surgeon. We have Leslie Awasam, who is a nurse anesthetist, and then Tenny Tolafari, who is a cybersecurity IT specialist. And they started off as mentors, and they became friends, and now they're partners. They have taught me everything that I know. I started out investing in their deals, and now we're partnering together with a common mission, and that is to bring these amazing institutional grade assets to our investors. And then Chris Lentos with EM Capital, he is like our asset management guru. He has 21 years of just focused on like real estate, apartment complexes, multifamily. He is a wealth of knowledge. He's done over $800 million in transactions, and he just brings that wealth of knowledge in acquisition and asset managing. And then we have Brad Kanjamila. He's with Crest City Capital. He is a real estate developer. He's done about $132 million in transactions in over the last 5 years. So just combined with our whole team, it's almost over 50 years of like multifamily real estate experience. And it's really focused. Our main goal is to maximize our returns at Grove Park View. And then the day-to-day operations, we have Asset Living and their property management team. And they have, and not only them, but our on-site management team. So Asset Living manages over 275,000 units. And Grove Park View will now join that family. But on the on-site team has about like 75 years of experience. So they have been working at Grove Park View for like, I think some of them have been there for over 30 years. And we are getting all of that experience. They're joining our team, and we're like thrilled and excited to have them. So I want to real quickly, as we wrap up, I want to share something with you. So I kind of shared when you're assessing deals like Grove Park View, you need a framework, and I want to share that with you. And I think this is the same framework that like has helped billions of families like really grow wealth, and it's typically reserved for family offices, but I wanted to share that with you. So as you're looking at your next property, I want you to think about this and to be using this every time a property comes to you, or like an email, someone says invest, pull out this framework, look at the deals from this mindset. And I think that it will really help you, because then you're really picking quality assets. and you're also asking the right questions. So we will drop it. If you are on your computer, I think on the bottom screen, you should see something that says apps. Click on it. And then you should see, it says, I think it says handouts. And then if you're on your phone, if you click more, I think you can get the handouts. But I wanted to share that with you. It's a PDF form. Just download it, have that, review it. But this is exactly what the ultra wealthy investors look at before they make any of their investments. So real quickly, I'll run through all 7 of them very briefly, but that handout it's very detailed, and it's really going to help you. So think, when you're looking at a new investment opportunity, think asset fundamentals. So think location, 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 but think condition, look at competitive position, think everything you can touch and see. Like, I would love for anyone who wants to go visit Grove Park View to just let me know, and I'll set up a time for you to go and take a look at it. But you also think about market analysis. So think about all the market forces. So think demographics, think job growth, think wage growth, so income, think jobs, who's moving to the area, what jobs are available. These are all drivers that will determine long-term demand. And think about financial performance. Think numbers. Don't think about the current performance. So look at historical trends. Like, look at the profit and loss statement for the last 3 years. See how it's doing, and then look at future potential. And then risk assessment. Make sure that you identify and mitigating every possible risk and threat to capital. Like, what is your interest rate? Where are you? What is your plan? When you think about exit strategy, which is also another one. But then think about the management team, right? Look at the team's track record. Ask me questions. What have I done? Who have I partnered with? How are my investors doing? All of those questions will help make sure that you're ensuring performance on your new property. And then when you think about legal and tax structures, right? How is the deal structured to maximize tax efficiency and protect capital? That is also important. And then finally, exit strategy. What are the ways, what paths do we have to be able to to be able to exit and to be able to get our liquidity and value realization? So that's something you have to think about when you think about end game. These are the questions that you should be asking, and now you know them. And so the next deal that comes to your table, these are the things that you should be thinking about. This is doing your due diligence, which a lot of ultra wealthy investors do. Okay, so as we wrap up, this is your start to thinking about institutional grade investing. This structure is typically reserved for institutional investors, for large investors, for ultra wealthy investors, but this is exactly how you can do it. And you can start with a property like Grove Park View, right? And I want to show you exactly how you can participate. So in a few weeks, think about how you can position yourself along with institutional investors as you start thinking about what the year is, or what next year brings to you. And I see all the questions in the chat. I'll get to them in a second. But so I want you to notice the fundamental difference. So I'm going to go back to the beginning a little bit and notice the fundamental difference between a traditional portfolio and an ultra wealthy portfolio. I hope that the choices are becoming clearer to you as you have seen them being laid out, right? Now, I want you to picture your portfolio, where it is today, and how you can transform it by using some of these principles that we talked about. And then decide which approach better serves you and better serves some of your goals. So we have gotten a ton of amazing response, especially in the last month. So I want you to, a link is going to pop up right now. If you're interested, I want you to go ahead and just fill out a simple form, and one of our team members will contact you. But because of just how fast it's been building, priority is now limited, and it's first come, first serve. As of today, as I'm speaking to you, we are 88% subscribed. So we're almost at the finish line. But I want you to, as you think about it, I want you to determine the next steps. What next steps will align with your goals? And then I want you to take action based on that. I think that's the most important thing, is let's take action today. So book a call with a team member, one of us, and then we can take it from there. And the biggest thing is making sure that this aligns with your goal. This aligns with your big picture. This aligns with your wealth building strategy. And the process is simple. Like I said, spots are limited, especially also it's towards the end of the year, and people are looking for different avenues to invest. So let's look at where you'll be in 30 days, where you'll be in 60 days, where you'll be in 90 days, right? Because like I said, the best time to have done this was 10 years ago. but the next best time is today. So like, what timeline works for you with your wealth preservation goals? So look at the next steps and like make sure that it makes sense for you and then do it. So like I said, there should be a link popping up, and then you can just go ahead, fill it out, and then we'll definitely be in touch with you. So before we wrap up, right, I want to ask you something. Every person who has built really lasting wealth, they can point to a decisive moment, a moment that they took action, that they stopped thinking like the masses and they started thinking like the ultra wealthy. Today, I've shown you how the ultra wealthy will preserve their capital in any market. So it doesn't matter what the market is, they are well equipped, they're educated, and they know to take action. I've also showed you why Grove Parkview embodies these principles. But even more importantly, I've given you the exact framework on what to use and how to evaluate every additional property that comes your way. So this isn't just, another real estate deal. It's an opportunity to start investing just like the ultra wealthy do. So you have two choices right now. You can leave here today with great information. Yes. Or you can leave here with great information and take action, right? The ultra wealthy, they did not build their fortunes by waiting for the perfect timing. And I said that earlier, but they built it by recognizing, the opportunity and then moving decisively. So the next step is kind of simple. Schedule a call with the link on the screen, and then we'll be able to talk to you. And the first step is just really aligning, like I said, understanding your goals and making sure that we align together. But that's like, I think that is the most important thing. But you have to take action, you have to make the decision, and you have to say yes. So the big question isn't like whether these strategies will work, right? The question is, when will I start implementing them? Will I start implementing them? Can I start implementing them today? That is all I got. So thank you for your time, and I'll open up to questions. And before I jump into questions real quickly, I just wanted to invite everyone. So in January, I'm launching the Expansion Blueprint series, and it is a exclusive 4-part. It's a deep dive on like breaking free from success prison and really living an expansive life as the new year starts. So it's a series that will take you step by step through like the exact framework for breaking into a life of like purpose, of wealth, of freedom, because then that's the start to becoming ultra wealthy. We'll cover things from like, thinking about what traditional success traps are, and then designing freedom and living with true purpose. So if you are interested in this, and it's free, I just want to be able to I want us to grow together. Scan that QR code, just put your information, and as soon as it starts, I will definitely be in touch. On that note, thank you so much, and I will jump into questions. So I'll start off with the questions, and then thank you. I will start off with the questions in the question bank, and then I'll go back and see, okay. What are some examples of income producing assets? I'm going to start at the bottom and move up top. So what are some examples of income producing assets? So we talked about it, and I think maybe you asked it before I answered it, but think about real estate. So think about apartment complexes, think about storages, so like industrial storage. Think about businesses, like being part owner of businesses. Think about what else would you think about? You can think about like retail, so like investing in retail opportunities as well. Those are some examples of income producing assets, and those are things that you can start investing in. Okay, so Tiara asked about, can you explain a little bit more about cost segregation? Okay, so this is a great question, right? So with every property, when we buy a property, we go through a process with a structural engineer and an accountant. We do something called cost segregation. What that means is that we go into a property, and we are able to depreciate every asset The only things that we are not able to depreciate is the actual physical structure and land. But everything else that kind of depreciates over time, we are able to get that as a tax benefit. And there was a law that was passed a few years ago where you can fast track all of that depreciation to year one. And so 3 years ago, you could get 100% of that bonus depreciation year one. That is slowly phasing out. So we're at 60% now. You can still get all of your depreciation benefits, but it's over 27.4 years. But right now, we could speed all of that to year one. So this is just another way to get tax benefits on a property, on every new property that we buy. So that is exactly so the benefits, really, you're just thinking about tax benefits that you can get. So with depreciation when you get, like when I mentioned that we get $27,000 in depreciation for your $100,000 investment, that $27,000 it's offsetting all your passive losses. So like all the distributions that you get on this property, you're not going to pay taxes in them because you have $27,000 in like almost like paper losses. So anything else, any additional monies that you get is just going to be subtracting from that 27,000, but only passive losses. So your 1099, your W-2, your active income, the $27,000 does not contribute to that. Okay, so good question. So Tara asked, why are they only selling for 49? So I told you that we did. So it was valued at 60, but that valuation was done. The property right now is worth, based on where the market is today and based on what we were willing to buy, our offer was for 49.1 million and they accepted it. So with every property, we do significant underwriting and we make assumptions. And so based on where the market is today and based on what we thought the value of the property is, our offer was 49 million and they accepted it. Examples of hard assets. So I think I kind of answered that with like similar to like income producers. Hard assets are things, think about like land, think about real estate, think about things that are, like time does not erode them. Those are examples of hard assets. Can you explain the split? When you mean the split, I think you mean 80-20 split. And so what I mean by that is, this is a really good question. So let me explain it. So Class A investors, right? I told you they only want preferred return. So on the capital stack, and the capital stack is how people get paid. So the first people that get paid are lenders. So the people who we borrowed the money from, they get paid first. The next set of people who gets paid is our Class A investors, because they don't want the back end. They only want money right now. So they're going to get paid that 10%. After that, then Class B and Class C investors get paid as well. And so, but they're getting that preferred return. Their preferred return is 6%. Their preferred return is 6% for Class B, and Class C, it's 7%. So before we as the operators get paid, you are going to get, as a Class A investor, you're going to get first, you're going to get 10%. Then the next group are B and C, and they're going to get 6 and 7%. Now, when we sell the deal at year 5, based on your initial investment, let's say $50,000 or your $100,000, right? Based on the profit made on your $100,000, you're going to split it. So you will keep 80% of the returns, and we as the operators, we will keep 20% of those returns. So if you add all your 6% that you had been getting every year, plus when we sell that large 80% that you got on the profit, when you add all of those together on an annual basis, you were making about 15.5% to 18% on the deal. So that's what the split looks like. So you're getting something every year and you're getting it in distributions. And then at the end, you're going to get a large sum. That's the split. And that's how it differs between classes. And that's where the 15 to 18% comes on an annual basis average over the 5 years. Tiara asked, can you earn a lot at the end in terms Class B and Class C, you can earn a lot at the end of the term with a split. Yes. So, yes, this is what I just explained. So, Class A, they just want cash flow right now. B and C are like, you know what, I'll get a little bit now, but like I want what's at the back end because it's going to be bigger. And that's exactly why. And so, if you looked at the numbers, remember that slide that I showed you about the sensitivity analysis? Class A, they're looking to make about 1.5%. So they're looking at, if they invested 100,000 every year, they're going to be getting 10,000. That is, and at the end, they're going to get 50,000. That looks like 1.5 times what they put in. But if you're a B and C investor, you're looking at getting 1.78 times. So you're making more because you're waiting till the end. Oh, I didn't start and end these two. And okay, so one more question. Go ahead. And if you have any other questions, please put it in the chat. I love to answer questions. Yes. So based on our assumptions and based on the exit cap rate, we are looking at selling at about 68 million. Okay, so yes, we could talk about that. And if you want to, so I will tell you, Tara asked, like, is there a coaching community? I'd like to sit in rooms with you guys, seeing how you assess these multi units. Great point. And I would love to teach you as much as I can. I will tell you this though. The way that I learned this is that I started as a passive investor. So with this deal, I remember my first deal as a passive investor. I started asking questions. So every week, every month we would get statements. So we would get expense forms. We would kind of just see how the property is doing, right? And I started learning from there. So I started asking the operators questions, and I was like, what is this? Why did we do this? How much money did we make this year? How much expenses that came out this quarter? So all of that is like a really, really good way to learn. So I would definitely give you more information about that. Tiara and Danielle, if you just like fill out the form, I will definitely be in touch with you guys. Okay. Perfect. And we just put the form on the bottom. If you do that, I will definitely be in touch with you guys or ladies and help. If there are no other questions, we will end. I just want to say a big thank you. I want to say thank you to everyone who showed up. Is there a question? Yes. Oh, there's one more question. Okay. Before I say thank you, another question came. If the investors get about 27% of their investment in depreciation year one, how much would the investor get depreciation year two? So that's it. So you're going to get that 60% year one, and then the rest of it is split in the years that we have the deal. So the split is just going to be whatever is left over those years. The exact number comes out in your K1, where our accountants take care of that. So if you want specific answers, I will get those answers to you. Mona Lee said this was phenomenal. Thank you. Are there any other questions? I know that last question came, and I will get you specific answers, and I'll post it. I might actually just, when I send out this video, so we will have you will have the video and the template tomorrow. I'll have everything out tomorrow, and I will have that answered as well. Okay, I'm gonna give you guys, thank you for hanging out for about an hour and 15 minutes. It was so awesome, and I hope that I hope that I was able to educate and to give you value. And if you have any questions at all, and that it if you have any questions that are not even tonight and you just want to reach out to me, please feel free. I think that was the last slide. Yep, I forgot to put it. So yes, feel free to reach out. You can find me on LinkedIn and any social media platform. That's our cell phone number, and then that's my email address. So if you have any questions, please feel free to reach out. But on that note, have a great evening. Happy holidays. I hope everyone gets to slow down a little bit and reflect as the year comes to an end. Bye, everyone.